Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, April the 10th, and want to take just a brief minute just to discuss what happened as we had quite the down week last week in equity markets, with the S&P 500 down 9.08% on the week. Yes, that is correct, down 9% on the week. And the mid caps were down just right there in line, down 9.14%. And the small caps, as measured by the S&P 600, did better. They were only down 8.2%, but are down worse year to date than, of course, your large cap stocks. And so last week was just an absolute get me out of the market as we got into Friday and into some of those selling on Friday. You saw so many great companies being thrown out with, at dirt cheap prices. And I wanted to explain why we kind of saw some of the behavior that we saw on Friday and why that was. And a lot of that is due to margin debt and leverage. And that's why you saw such an extreme response to the downside on Friday. Is what happens is when you have a brokerage account, and hedge funds do this a lot, and we were at record levels of leverage heading into this market turmoil. And so just to make things easy, if you had a $100,000 account, let's say they would add $50,000 worth of margin, so you could then spend theoretically up to $150,000 in your account on stocks. But as the value of those stocks come down, the margin still is at that 150 and the balance dips below 150. What happens is the margin bankers will call and say you either need to put up more cash into your account to get the balance up, or you need to sell stocks to pay off your margin debt. And what you saw Friday was a lot of forced selling on margin calls, especially in the afternoon, and that's why you saw it accelerate after the 2 o'clock hour. That's when a lot of those margin calls come in. So that's why you saw a significant amount to the downside. The good news is when this is the case and you have all of these big flush outs like we saw, that allows the system to reset. That doesn't mean that we'll be on a straight line up from here, but it allows for a reset of the system. And one of the keys here is you're seeing volatility both on the up and down. Yesterday we saw the greatest day in the S&P since 2008. It was a historic day in the NASDAQ, with the NASDAQ up 12% on the day when President Trump announced that he was going to pause tariffs 90 days and only be 10% for everyone who's reached out. And now he's at over 100% on China, and that's why you're seeing a reaction today in the markets, as well as you're seeing a pullback just from such an extraordinary day. And one of the things that we wanted to talk about, and that I really want to talk about today, is the importance of staying invested during volatile times. And so the average 5% pullback is not going to get you typically that bear market number. It's 11% of times that you get a 5% pullback, you actually get the 20% down close. If you are at a 10% drawdown, you have a 28% chance of actually getting to the 20% bear market close drawdown. And on Monday, you really saw the S&P hit the down 20%. The NASDAQ has been in bear market territory, but the S&P 500 hit that down 20% intraday on Monday and really rallied off of that number. And why it's important to stay invested is when we have big bouts of volatility like we've had, and you miss out on, if you leave the equity markets because of you're worried of the volatility is going to continue, you can miss the big recovery days. And the big recovery days are incredibly important for your portfolio and the recovery of your portfolio, and you obviously cannot participate if you're not in the market. And why it's important to stay invested through this is the average recovery, the best day that you're going to have in a recovery from a very volatile session typically happens on average within 2 to 8 days after you've had the big drawdown. So right afterwards, if you go back to 2008, 2009, you would see incredibly strong days to the upside as well, even with the market down 40% as a whole. The other thing to take into consideration here is when you're not participating in these big upswing days, you miss out on the return. So, for example, if you missed the 10 best days last year because you were sitting on the sidelines, you would have only generated a return of 5% for the year. Whereas if you were fully invested the whole year, you're at 25% total return year to date for 2024. So, it's important that if you can see through these bouts of volatility, and when you see significant drawdowns in the market, you may not time it perfectly. I know I certainly do not, and we don't claim to at River Place, but when you see big drawdowns like this, they create great buying opportunities for those of us that are still contributing and saving and doing those functions. So the majority of us, they create great buying opportunities. And if you're not and you're retired and you're watching this and you're wondering what to do with your portfolio, well, this is a great opportunity for you to reevaluate your positions, making sure that your portfolio is providing that stable income for you that you can live off of to allow the principal to be more volatile and you can live off of the income. So if you have questions about how to navigate these markets, why it's important to stay invested, or why you might want to work with a professional through this volatile period, we'd love to talk with you about that and why it's important. So you can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Stay steady, and thanks for watching.